Welcome to another Bitwave Quick Hit. Today we're talking about crypto fair market valuation. Pat, what is fair market value in crypto accounting?
All right, we're going to be talking about two terms today: fair market value and fair value. We'll get to that. Fair market value is an IRS term, and it's the idea of it's actually really interesting how they do this, but it is a theoretical price that a willing buyer and seller would agree to for an asset at a given moment in time. So the reason that you care about this for crypto accounting is not every crypto transaction you do happens on an exchange where there's a really obvious price point to it. So if I go to Coinbase and I buy one ETH for $2,000, this doesn't really matter. There are places where this matters, but we'll talk about that later. But like, if I paid USD for crypto, that's my cost basis. That's what the IRS cares about. That's all that really matters. But there's a lot of other ways that our customers actually get crypto and spend crypto. And that's where fair market value really is important because you need to determine a fair market value for the crypto when you got it so that you can report that on your taxes. So let's say that you're a staker and you go out and you are staking Ethereum, and every 12 minutes, whatever it is, it's one epoch, you get a little bit of ETH, and it's you get zero point 0.1 ETH, you get zero point 0.1 ETH. Well, that ETH isn't coming out. You're not getting that from an exchange. There's no price that's implicitly tied to that. And so you actually have to give it in order to then turn that into revenue. Now, there's a whole different discussion as to whether or not that's revenue or not. I'll leave that to the policy wonks that are out there. It's a great discussion about whether or not you should treat that as created goods or if it is actually truly revenue. But for now, we'll pretend that it's revenue. So when you get that revenue, you need to price it because you need to pay income tax on it. And so there's a lot of different ways that you're going to go about doing that. And we'll get into this, but the idea is that fair market value is this concept from the IRS that determines a price for an asset. And in our world, in the crypto accounting world, it's used when you don't necessarily have a USD denominated amount tied to an asset. So that's expenses. I'm paying my Ethereum fees. I'm sending money to a staking account. I'm paying I'm earning staking rewards. I just mined one Bitcoin. All of these things are trigger a process where you have to correctly and fairly value that crypto you just got so that you can both track it for your historical purposes, track it for tax, track it for gain loss, all of that, the stuff that Bitwave helps you with. But then also so you can report that up to the IRS and say, hey, I just made $60,000 because I mined a Bitcoin.
Well, before we get too far, so FASB has the concept of fair value. What is that and why does it matter?
So fair value it is slightly different than fair market value in a funny way, and the way it's used also. So the biggest difference between like FASB and tax accounting, there's obviously a lot of different differences and all these sorts of things. But in FASB, you do these in your normal accounting. One of the things you're expected to do is to accurately reflect your holdings on your balance sheet. So if I have $1 million in Bitcoin, I want to reflect on my balance sheet so that an investor coming in and looking at it can tell how's my business doing. Now, for a long time, there was a requirement that every single digital asset was marked as an intangible asset on the balance sheet. So what that meant is that an intangible asset goes through a very, very special revaluation process called impairment, where you can mark it down, but you can't mark it back up until you sell it. This was always applied to things like domain names and intellectual property. There wasn't actually a ton of intangible assets that were floating out there until crypto came along. So a great example is think about the domain name Enron. You're not going to mark Enron up. No matter how good Enron's doing, the domain name's kind of worth the amount that it's worth. Like it's not really going to get worth too much more. But then you have a thing like they like happened to Enron, and the company goes out of business, or FTX is maybe another one. Then it's super easy to mark that all the way down and just sort of write that off essentially. So that's where impairment comes from. So fair value it's a FASB concept. It's very similar. It's as opposed to a hypothetical willing buyer and seller, which you use for fair market value. Fair value looks at actual market activity and uses that to price your asset. And so in that case, the FASB rules are, the current rule set is that for certain assets that are treated as securities, so RWAs, there's a handful of other ones, you still want to do some form of impairment on those. But there's a handful of assets that they said it's okay to do a fair value treatment on. So Bitcoin, Ethereum, anything that doesn't have a strong centralized governance model. So most of the tokens that are out there that you mint and that turn into tokens like Dash and things like that, all of these you can fair value up. And so that means is that if I'm sitting on a thousand Bitcoin, I'm allowed to mark it up or mark it down based on the price at the end of the month when I'm going to put together my balance sheet. So if I hold a bunch of Bitcoin at $60,000 and it goes up to $70,000 in the markets where it's trading, then I can make a fair value analysis and I can mark it up on that, and that my balance sheet now just went up by $10,000 on that. So slightly different uses, because on the fair market value side, because that's used for taxes, you're using it for your gain loss reports on your taxes, and then obviously your income reports as you're reporting income.
All right, well, how do you do it? How do you pick a pricing source?
Yeah. So what you generally want to do is there's a lot of different ways to do it. A lot of folks will just use one of the indexes that are out there, and that generally is okay depending on the guidance from your advisors and things like that. So there's a bunch of different indexes for Bitcoin or for Ethereum or whatever it is. If you want to go to the next level and be more precise, it is generally acceptable to look at the markets where you are trading and do some sort of market analysis to determine what's the market you're using, and then basically go to that moment in time that you are looking at to pick up a price for the asset. So let's drive into a real world example here. And there's always, as with all things taxes are kind of nice because there is this like level of effort analysis that often the IRS and accounting both kind of go through to say, like, do as much work as you possibly can to kind of get this done as accurate as you can, as is appropriate for the materiality of the item. So what generally happens within Bitwave is that most folks will use 1 hour resolution. So they'll pick a market they like, so Kraken or Coinbase or Binance, whatever it is they do the majority of their trading on, or they'll pick one of the indexes, Coin Market Cap Index or the Crypto Compare Index, and we'll grab an hour. So if you mined that one Bitcoin at 11 a.m. or 11:05 a.m. on Tuesday, what we're gonna do is we're gonna go to the markets. We're going to look at the time slice from 11 a.m. to noon. So we'll look at that 1 hour period. That means that there's some nice properties there. It means all the assets, all the transactions in that time period are all priced the exact same way. That makes your life a little bit easier, and it makes the taxes on this stuff a little bit easier. You can make choices here. So what we tend to do is most of our customers will use the close price. So we'll take that 1 hour slice, they'll take the close from that 1 hour period, and they'll apply that to their digital assets. Now you can go as extreme as you want. If you want to go to the next level, you can grab 1 minute slices. Certain exchanges will actually expose 1 minute slices, and you can use the average, the midpoint between open and close. You can use the low if you want to be very conservative. You can use the close. Like, you can kind of do whatever you want. But in terms of reasonableness and reasonable amount of effort and reasonableness for auditing, it's a lot of folks will do this 1 hour slice and then use the close from that period to basically do the fair market value for that particular moment in time, because that really is showing what buyers and sellers are willing to trade that asset at. So Bitwave does that, and we keep all the records for you. I mean, this is the really cool part about it, is that we keep all the pricing details: where we got the price, how we got the price, how we arrived to it, did we have to go to multiple places. We keep all those records, and this is important for you. If you're doing this by hand, you're doing this in a spreadsheet, you have to keep all those records. You have to take a screenshot of the exchange where you got the price. You have to write that down. You have to have really good records. You have to keep it in a place that's nice and safe. Record keeping is the most important part of your tax journey, or your crypto accounting journey, by far, and that's obviously what Bitwave automates for you.
Well, hopefully this was informational, and definitely talk to your tax advisors or your accounting advisors. Bitwave has a lot of partners who work in this space. Always happy to connect you with someone if you need help with any of this.